given our subject matter, we thought we start with a very high-level basic overview of securitization and specifically an RMBS structure, and identify the traditional key players as well as emerging new players in the market, and as well as some of the main structural features of an RMBS transaction. On that note, JB, could I please ask you to walk us through a basic structure?
So I think, as always, I think that a diagram can help because those structures can be a bit complicated. I mean, an RMBS is very similar to most type of ABS transactions. I think you saw, if you were in the panel earlier, that one of the key features of a securitization is that you want to segregate your high quality assets, those assets who have a very sort of predictable, that can generate very predictable cash flows. So that's why a resi mortgage is so you're probably the best example of a good asset which you can securitize, mostly because people tend to default on everything else before defaulting on the loan on their house, which means that sort of a big part, at least in the UK market, of the securitization market is about the securitization of resi mortgages. So looking at the diagram, effectively starts by the sale of the resi mortgages from the originator. So that would be your typical lending bank. And this by an SPV issuer, and we'll go back to why it's important to have an SPV issuer a bit later, and the SPV issuer will fund that purchase through the issue of bond in the debt market. One of the things you try to achieve in putting a transaction like this is to make sure that your assets are ring fenced. So what you want to make sure, that's the reason why you use an SPV issuer, among other things, is because you want to make sure that the issuer, the owner of the assets, doesn't have any other assets, doesn't have any liabilities other than sort of the very basic sort of ongoing cost. You want to make sure that there is also those assets stay with the SPV, and there's no risk of anything happening to any of the third parties, in particular to the originating bank. You want that to be removed from any insolvency risk at the originator bank level. So by doing that, you ensure that the transfer of your resi mortgages from the originator to the SPV issuer is what we call, in legal terms, a true sale. And again, that there's no risk if something goes wrong at the originator level, that an administrator of that originator will try to go back after those assets. So that's one of the things you try to achieve through using that sort of structure. Sort of going for a high level as to who does what. We talked about the SPV issuer. What sort of a very important party is the servicer, because we said that the SPV issuer has no employees, so it cannot do anything to these assets. The sort of day-to-day management of those assets is going to be done by the servicer, which is typically in the resi mortgage space going to be the originator, because that's the party which knows the assets the best. Another important party will be the trustees, with the sort of a separation of the role between the bond trustee and the security trustee. The bond trustee will have the main relationship with the issuer and with the investors. He will be the main point of contact for the investors. Again, going back to the fact that the issuer is an SPV, he can't communicate he doesn't have the tools to communicate with the bondholders. So this is done through the bond trustee. And most importantly, the bond trustee will hold the benefit of the covenant to pay principal and interest from the issuer or for the benefit of the bond trustee on behalf of the bondholders. The security trustee will mostly, as its name indicates, will have the benefit of the security granted by the issuer, which is effectively a recourse to the assets. It will be the one which has the ability to enforce the assets if something goes wrong, if the deal is going wrong. Briefly, again, the swap counterparties, if you have a mismatch, let's say at the currency level, if you have assets producing a certain currency, but the bonds are denominated in another, there is a currency mismatch, which will mean that you'll need to have a currency swap provider just to manage that mismatch. So that was quite brief, but I think I'm trying to cover as much as possible in a short period of time.
Thank you. Appreciate it. I know, or I believe, there have been two key structural features of an RMBS in the market, one being static pool assets rather than revolving structures, the other one being a step up and call option given the life of the assets. And I was thinking, Frank, if I could ask you to comment on static pool versus revolving structures, and perhaps comment on master trusts. Another thing I would like to ask is, has there been an emergence of private equity lenders as new key players in the market? And perhaps, Cliff, if you could comment on specialty lenders.
Starting with the structures, the structures that we see in the European RMBS market, as its name suggests, static structures involve the sale of a portfolio, a ring-fenced portfolio, to a standalone structure, so amortizing from day one and creating a redemption on the notes from day one. Revolving structures involve the ongoing sale of loans in order to replenish the redemption, the amortization of the pool for a set period of time, say 5 years. And after 5 years, there's indeed a step-up and call features, whereby the sponsor has the option to buy back the loans. If not, the coupon, the margin on the notes, double, creating an incentive, an economic incentive to refinance the transaction. In contrast to standalone structures, master trusts involve the sale of the addition of loans from time to time to a larger pool, therefore enabling the issuer to issue various kinds of notes with different maturities and even different currencies. What we see in Europe is that the dominating model is the static structure, with two important exceptions. One such exception is the Storm transaction, Storm template in the Netherlands. Storm has turned to revolving structure since January 2017. And more recently, Crédit Agricole issued a revolving structure, revolving structure. You're asking me in terms of emergence of new players in the RMBS market. I think it's worth highlighting that the private equity-backed lenders have probably at least partially made up the gap left with, in terms of RMBS issuance, left by the high street lenders, the more traditional lenders. In the UK, for example, the UK Asset Resolution Trust has given rise to massive securitizations. In France, we have seen G Money Bank, private equity-owned lenders that has issued 3 interesting securitizations backed by secured consolidation debt. And last but not least, in the Dutch market, for example, the Dutch market is very much a two-speed market, with traditional lenders issuing RMBS, but also issuers with a distinct private equity flavor or fund flavor issuing the RMBS, which brings diversification to the RMBS market, a welcome diversification to the RMBS market.
Cool, yeah, so if looking at the mortgage market, you can see it from a credit quality perspective being split into the prime resi market for borrowers, which is really served by the high street. But then there's a whole range of different borrowers that doesn't necessarily suit, they don't fit the scorecard that the high street lenders have developed for those prime borrowers. So out of this, the specialty lender market was born, and it's been around for nearly, I guess, 30 years. Really started, I guess, with some of the American players coming over here, and has evolved over time, where we saw some of the people from industry, from the mortgage industry, also seeing that opportunity, setting up their own platforms, specialty lender platforms. If you look at the kind of products that they typically look at, if you're looking at from a credit perspective, they're not necessarily credit impaired, and we'll come on to the differentiation. So non-conforming lender or non-conforming client could be something as simple as someone who's looking on a buy-to-let basis, and that could be sort of the mom and pop looking to buy an investment property, or it could be someone who's actually a landlord who sets themselves up as their business and they have a large property portfolio being financed, but that's not served necessarily particularly well by the banks. Other examples could be right to buy, people looking for holiday homes, financing for that, military, people in the army who don't necessarily have a large credit history, people who are self-employed who don't necessarily have a track record, or don't have a salary slip that they can produce for every month for their underwriting. So that's how the market's set out to start off with. And of course, as more people came through it, then there was also the ability to underwrite people with an impaired credit history for whatever reason. And I guess everyone's heard about the subprime mortgage market, so I probably don't need to dwell on it too long. That's an area of the market which doesn't exist. That's now gone, if you like. It was a pre-crisis phenomenon. Now there is a lot more prudence, if you like, around underwriting those kind of mortgage loans. But it's now very few lenders will actually go down into that space, and it's more about credit impairment, credit repair mortgages, where maybe there's been a one-off life event that's actually caused them to have an issue before, which maybe caused bankruptcy. It could be something like a death of a spouse or a divorce. They've managed to get themselves back on track, proved a track record of 1, 2, 3 years, and there are some specialty lenders that will actually serve that part of the market. So pre-crisis and post-crisis, the world moved on after the crisis. Pre-crisis, I said it was some of the large US players were coming over here at the start of the market, the non-conforming market. Post-crisis, we've seen private equity firms being much more involved in them. Pre-crisis, there was a rash of bank acquisitions of these lenders because there was a way of getting a captive source of origination for the securitization platforms. Now, we don't really see the banks owning those platforms. They're much more involved in providing the warehouse finance for the specialty lenders to be able to fund those mortgages. It's much more now about private equity houses with the returns that they can generate off the non-conforming mortgage market, sponsoring those originators, and together with debt finance and securitization, very much driving that market at the moment.
Thank you. Gottfried, if I could ask you to give us an overview of the role of backup servicers.
Sure. So we work the structures that Cliff was speaking about with a lot of the new breed originators, where we've enabled them as the servicer to come to market, where they can, from point of sale, originate loans from the intermediary market straight onto our platform and then pass it through into the securitization market. We also do a lot of work as a backup servicer, where we stand directly behind the originator's own servicing platform. We offer a number of different models of standby, typically driven by the number of days it would take us to be invoked and step in and take on the servicing. It's an exercise that is sophisticated risk management. We do a lot of data mapping. We manage our exposure in different sectors and to different players within the space, because we have to take the view that we could get called on these transactions and have to step in. We have actually been called on one transaction. We are the only servicer in Europe, in the UK, that has been called on a standby. Lots of different reasons why they would invoke, typically insolvency, ratings downgrade, or a regulatory issue. With regard to the backup servicer market at the moment, it's giving confidence to investors and enabling the transactions to execute better than they would without the backup in place.
I should add also that this is often a requirement from the rating agencies for low-rated sellers.
Yep, absolutely. And we work with our originators, with the rating agencies, to explain how it's going to work.
JB, what is the role of an underwriter in an RMBS and generally securitization?
Yeah, maybe we should talk about the role of the banks, and I would draw a distinction between, so going back to the diagram, between the role of the arranger and the role of the underwriters/JLMs. An arranger would sort of work with the sponsor at the outset of the transaction and help structure the transaction for the client, for our client, the originators. That means working on the due diligence of the underlying mortgages, working with the rating agencies, working with the law firms, and once the deal is sort of at a well advanced phase to be able to be sold to investors, then that's where the other banks, the JLMs, the underwriters come, because that's really the banks have the relationship with the investors and are capable of reaching out to the investors to explain the transaction and effectively try to sell the transaction to the investors. So that in that sense, a resi mortgage transaction is not different from any other ABS. So and from the sponsor's point of view, from the originator's point of view, it will have experts who have the relationship with investors, capable of sort of knowing whether, considering where the market is at a certain time, whether the pricing offered by the potential investors is good enough for our clients. And also what this brings to the originator is the ability for, or knowing that as and when a price has been agreed between investors and the client, that the banks will underwrite the transaction before the issuance, that a not purchase agreement or subscription agreement will be signed between the issuer, which is an SPV, the seller, and the banks, where the banks will agree to buy the bonds. So that will be signed before the closing date. So the sponsor knows that as and when the deal is ready, the banks will agree to buy the bonds on the issuance date. And then the relationship with the investors is sort of between the banks and the investors, and it's for the banks to deal with that side.
Thank you. Jack, what are the fundamentals of residential mortgage finance and specifically RMBS from a rating agency perspective?
Sure. So I'll try not to rehash a lot of what's happened here, but at KBRA, through the lens of thinking about the fundamentals for RMBS, I tend to think about it through the general areas that our methodology works on. So some of that hits some of the areas that these gentlemen have already talked about. But I think that generally falls along 5 different lines. So the first of which is the transaction participants. We've talked about a couple of them here as JB's listed out. Primarily you're thinking about the originator, the servicer, who's working on the loans. Essentially the RMBS starts with the creation of the loan. And so, our first look, and we think this is a prime determinant of risk when we're thinking about an RMBS transaction, is who's originated the loan and how is it being serviced. And as I'll go through, one of the other tenets is loan loss modeling, but all of that can be driven by property or borrower specific information, but underlying that information, say income verification or debt service coverage or DTI, there are particulars of underwriting that are specific to a given originator that are important to know. Someone can calculate a debt service coverage ratio differently or a DTI differently, or even the level of income verification that's done can be different across originators. And so that's a large part of the review that we do is related to the transaction participants, not least of which is the servicing that happens on an ongoing basis after the loan is originated. So that's a big portion of it. The second fundamental piece that I would talk about is what we think of as agreed upon procedures. So as we move towards what will be the third piece, which is the loan loss modeling, we're thinking about what are the procedures set in place from an independent third party to verify the data that we're getting, to make sure that if we're understanding and applying risk assessments to a loan in an economic scenario, that the data going in is correct. And so that's a big piece of moving forward with an RMBS, is making sure you have the correct underlying data. The third piece, as I said, is the loan loss modeling and cash flow modeling. So when you're thinking about an RMBS transaction and how it works, the main thing you think of and the role of the rating agencies, that's probably the primary thought process here, is assessing the level of loss and risk for any of the loans in the transaction. So obviously that's a large part of our analysis. It's the most kind of indicative one that you'll think of when you think of our process. And typically that's done through applying a model process to the loans, looking at the borrower, the loan, the property level characteristics, and assessing a stress case risk related to our rating categories. So AAA being the highest economic stress, down to single B being generally the lowest level of economic stress, and everywhere in between, we're applying and estimating that loss. And then, as I think one of the other gentlemen mentioned, you can have different structures too, and so we'll evaluate the payment priority of the RMBS. It's another big fundamental process, this idea of tranching and creating credit enhancement, not just for RMBS, it's a structured finance concept, but still the structures, as we heard, can be a little bit different in RMBS, and applying a timing process on when those losses can come in, when prepayments can come in, can have a big impact on your bond, where it is in the structure, and the performance of it. The fourth sort of fundamental process is looking at the securitization legal structure and other transaction features. Again, JB mentioned the idea of ring fencing, and this is incredibly important tenet for structured finance in general and RMBS as well, to make sure that the assets are not going to be encumbered by some other entity, that you have clear and free access to the assets as the trust. We'll also review other important pieces of an RMBS. So you're looking at the rep and warrant framework of the transaction, for example, again, looking at counterparties and making sure that's being provided for well. And then the fifth, similar to how servicing works on the loan and ongoing basis, for us, a big fundamental part of an RMBS is the surveillance that goes on after the fact. The deal doesn't end at origination or issuance for us. It continues on as we periodically review information that comes in to make sure that our rating is kept up to date, and that we're reflecting that rating. And we try to do this basically as often as possible, just making sure that as periodic information comes in, that we're assessing whether action needs to be taken on the bond. I think that's an incredibly important point.
Thank you. Now that we've walked through an overview of a basic structure and identified the key players in residential mortgage finance, I think it would be good to discuss the role of securitization in residential mortgage funding. And Frank, what would be the benefits, or what are the benefits of RMBS? And have we seen a shift from one mortgage product to another in the continental European market?
The benefits are relative always. So if you compare, for example, classic comparison, which is with covered bonds, I still see two advantages of RMBS over covered bonds. First, it's been used heavily by banks to create liquidity reserve that they can use at the Euro system, and probably a lot more than retained covered bonds. And I think the second benefit, relative benefit over covered bond, is that in terms of credit enhancement, you've got probably lower credit enhancement than you've got over collateralization in a covered bond. So in terms of funding efficiency, RMBS still is more efficient than covered bonds. Especially if you sell down the capital stack down to BBB or even BB, as the private equity-backed lenders have done in the past, then there are an advantage of RMBS over covered bonds. Having said that, RMBS remains arguably heavy on regulation. You've got STS, you've got CRA3, you've got risk retention, you name it. So it's and of course, you've got the pricing differential. Covered bonds being a lot cheaper to issue for banks as opposed to RMBS on a like-for-like basis.
Cliff, what are the trends in the UK market
In terms of issuance, the market's very much at the moment impacted by the quantitative easing programs that the UK government's put in place, which has seen cheap funds effectively available to the banks that are out there and the building societies that can take advantage of that. So we've seen the transactions, instead of them going to the public market, have actually been retained and then financed through the BOE QE programs. So that's actually had an impact in reducing the actual real level of mortgage issuance that's out there. Having said that, though, prime mortgage issuance or mortgage issuance still forms the largest part of the overall market in ABS. And whilst the volume's been down slightly, what we're actually seeing is the number of issuers actually rising. So what's really happened here is that because there isn't so much asset actually out there for investors to buy, that's given a really strong technical backdrop for the market, which has been driving prices down. So we're seeing some really tight pricing, which is quite unique in the moment in the market, which has been great for the non-conforming mortgage market. Because obviously they're reliant on being able to churn their warehouse financing that they have in place to refinance that through the public markets. So it's actually produced a very strong market for these issuers. What that also means is that we've seen slightly smaller deal sizes. Typically there are bite-sized chunks of sort of 250 sterling equivalent that are out there, opposed to some of the bigger jumbo master trust trades that we saw before. And I think you need to look at the market as well. So we've got roughly sort of, say, 50 investors that are playing in the market. It's not a particularly large investor base, but there is actually a big clamour for the assets there. So that's been great as well for the strengths of the market performing. I think we're still going to see more lenders still queuing up to come into the non-conforming space. So again, that will continue to boost volumes from that perspective. But I know that some of the bigger issues, some of the banks are obviously acutely aware that QE is going to come to an end. So I think we're going to see more of those bigger transactions, some of those players come back to the market, which is obviously going to have a pricing impact over time as well. I think one of the key features that we saw, which is a little bit interesting, is that January had a really strong start, and then there was a big tail off, whereas normally in previous years you normally see a good start in January, but it actually builds up over the first few months. Whereas actually we saw a real drop off in February, and then it slowly built itself back up, which actually I would perceive as being a strong second half to the year, because I think the anticipation is that year on year we'll have a similar level of issuance compared to last year.
Thank you. Jack, we know there is a big, huge agency mortgage market in the US, and I'd like to ask, in your view, what is the reason for the agency mortgage market not being able to take off in Europe?
Sure. Well, it's a kind of a funny question for a U.S. guy to hear, because, of course, in the U.S. the conversation is much the other way about trying to wind down the GSE and agency market on the U.S. side, which is a monumental task. I think, frankly, that's probably, I would say, the biggest reason why there hasn't been, from my vantage point, an agency equivalent market across Europe for European countries. It's a massively large undertaking to create one, and then to have the example looking into the U.S. of how that came about, and specifically around the most recent crisis, about the role that was played there, across the mortgage market, but including the agencies. I'm sure the impetus, I know there were some discussions around similar timing to say, all right, there could be a liquidity provider in the market, provide some stability, but ultimately it's a large project, frankly, to take on and put together. The big example is that you have, although there have been many good and important changes, I would say, at the GSEs since the crisis, sort of a bad taste in everyone's mouth after going through that. I should say that, we've been going on, there's a lot of inertia to having something like that. I mean, in the U.S. it's been very difficult to have reform efforts go through. They're still in talks, various different reform efforts for the GSEs there. It's one of those things where when you start it up, it's kind of hard to get off of. I mean, we're probably seeing that a little bit with the asset purchase programs, that there's inertia to these types of things when you provide that different source of funding. And there's certainly, there's certainly a liquidity and stability use for it in the U.S., I would say. And you do see it in some markets. You have something kind of similar in the Netherlands. You have NHP, and I think you have offshoots. Like I said, some of the asset purchase programs serve similar purpose. And I just don't think you have. The other issue is you have a sort of balkanized market here, in the sense that each country has its own sort of product that's typical. In the U.S., the agency product is a relatively homogeneous product. They set their guidelines, seller guidelines out, and you deliver into that. Whereas any different European country can have bespoke issues related to mortgages that are just typical, and so you'd have to look at it at the country level. It's a very difficult undertaking.
Thank you. Frank, how can securitization deliver relative value to investors, mortgage lenders? I know we've seen a trend in terms of non-performing loans in the market. We do see still public issuance, which is good. And is there a trend towards a private label movement in the market, particularly certain jurisdictions in Europe?
I think it's a good transition from what Jack said, where in the US market, where you have standardized RMBS market, on the contrary, and this is why I like this market. It's very much diversified. You've got Subprime RMBS, you've got Prime RMBS, you've got private equity-backed RMBS, you've got the AAA tranches, but you can also be offered AA tranches or even equity tranches. We've seen NPL securitization. It's very much at the moment remains an Italian business. We've seen reperforming mortgage securitization in Ireland. So there is a lot of diversification, which to me delivers value to investors. At least they can pick up what they want.
Thank you. Cliff, briefly, in the UK, buy-to-let mortgages, again, non-conforming.
Mm-hmm. Yeah, I think from the different places you can actually go for buy-to-let funding, there are so many different advantages to actually being able to fund through securitization. So if you think from a high street lender or a challenger bank point of view, you've got diversification of funding, so securitization versus covered bonds versus depositors' money. If you're in a specialty lender position, and basically it's the primary source for being able to refinance your warehouse, and it's obviously much cheaper than direct equity funding cost. And from an investor perspective, it really allows you to choose which risk profile you really want, which tranche of bonds, where you actually engage with the market, where you buy. And also, it gives you the benefit from a significant risk transfer point of view. We've seen some of those trades over the last few years really develop, where you can actually deconsolidate those assets and remove them from your balance sheet. So you can de-risk yourself from those trades, rather than the traditional approach from securitization, where you still have linked presentation, still have that risk there, apart from the skin in the game slice, the risk retention element attached to it. So whether it's a buy-to-let mortgage or a non-conforming mortgage, it still has that play about being able to give you access to funding through to the market.
Jack, any possibility to give some information on the volume, particularly on public issuance volume?
Sure. So looking at AFME has put out some issuance volume across the European countries. From what I can see from there, in 2017, it seems like the RMBS issuance was about 120 billion or so. It matched roughly where 2016 was in terms of size, although there are some trends there in terms of which countries kind of contributed to that a little bit differently over time. I think we mentioned some of the issues that have gone on there, and a couple of larger issuing countries like the UK and the Netherlands both had decreases in issuance from 2016 to 2017. And I would attribute that to probably two of the topics we've been talking about here, which is looking at the different funding sources, which is either doing covered bond issuance, which I know a couple of banks and other lenders have kind of picked up on that a little bit to diversify their funding sources, and then as well through the various funding schemes through ECB and BOE. And so, my guess is that with BOE having already wound down on that 2018 issuance, I think we would agree maybe it stays about the same, maybe it comes up a little bit in the RMBS space. It's still a questionable factor of how much covered bonds is going to eat into the RMBS issuance. And then similarly with ECB, say in countries like the Netherlands, where you kind of expect that to pick up at some point, notwithstanding the covered bond issuance side of things, where if the ECB kind of rolls off at the end of this year, that you could see that into 2019.
We've heard covered bonds as a funding tool quite a few times, and perhaps, Frank, if you could just give a very brief overview of what covered bonds are compared to RMBS and perhaps the whole loan market, and what can we expect in a post-QE environment?
Okay, I'll go very briefly over covered bonds. Covered bonds, basically what sets apart covered bonds and RMBS is the dual recourse nature of covered bonds. There are obviously different regulatory treatments attracted to each other, with LCR, for example, RMBS being level 2B as opposed to level 2A for covered bonds. Lower capital charges under the CR and the Solvency II for covered bonds and RMBS. So quite different breeds of instruments. In terms of the whole loan sales market, by definition, this is a bilateral market and therefore a confidential market. It's still at the margin, but what we've seen is that a number of insurers have actually looked at taking an exposure on the residential mortgage market by buying from lending institutions loans in whole, taking the first loss. For them, that's the attraction of matching long-term assets with long-term liabilities. It avoids the punitive charges that they have under RMBS, and these trades can be implemented very quickly.
Thank you. Godfrey, any other trends, new mortgage products that you've seen in the market?
I think the move of the private equity firms is bringing some innovation in. There are a lot of new lenders looking to come. They've got to look different. They can't just chase the same buy-to-let market. It has a finite size. So we're starting to see some moves in shared equity space and perhaps later life lending. It's going to be a big area to push in the UK. And we've started to see some really interesting products come in that space.
Thank you. Jack, again, very briefly, I know we touched on the controversial topic of agency mortgage market, but any other significant differences between the European and US market?
Sure. I mean, there's a lot of significant differences. I'll do this briefly, but there's a lot of similarities too, frankly. Just working with my European counterparts over here, a lot of it's not significant. There's a lot of terminology differences, frankly, for a lot of the same things. A couple of the interesting things, I'll pick up on what Godfrey said about the later in life lending. The UK and Europe in general seems to have a growing market for equity release, which I know is a little bit separate from what you're talking about, transactions. And we have in the US had sort of a decline in that area. There's a lot of optics around doing those sort of products as well. And I think there's a good product base for that in the UK for funding. The other one I'll say is, for example, the buy-to-let. Buy-to-let issuance out here is a lot stronger than in the US. In the US, what we would call investor loans are sort of typical piece of an RMBS transaction. It's not usually typical to have a standalone. In fact, KBRA just rated probably the first agency investor loan deal that's been done, and that just happened last month. Whereas buy-to-let's its own product here. Of course, the agency market takes on a lot of the prime product, and we don't see one of the other large differences just in terms of the funding sources is that banks in the U.S. most of their product fits into the agency box, and that goes into guaranteed securities. Whereas for the U.S. we do a lot, like non-bank funding has been a significant, specialty finance lending has been a significant source of lending in the U.S. for a while now, and that sort of leads the market for what we call non-agency, but basically standard private label RMBS, and so we see a big difference there. And on the loan level, probably the biggest difference I would say is recourse versus non-recourse. In Europe, having or at least in the UK, having recourse loans is a significant driver versus in the US, it's just not the same.
Thank you. Just one topic which I think will be discussed quite frequently during this conference, and it's regulations affecting the securitization industry. Thought it would be good to just highlight the principal regulations affecting the securitization industry. And I'm looking at JB.
Yeah, there is a flurry, as everybody knows. It's on everybody's lips at the moment. So I'm not going to dwell on this, and I'm not going to dwell on STS. I think there are a number of panels going to discuss STS, but obviously, resi mortgage finance is sort of the prime example of the prime type of asset, which could be interesting from an STS point of view, because if you want simple and standardized and transparent transactions, then people know with the mortgages, people should have enough information to be able to comply with the various criteria. So from speaking to my colleagues on the business side, I think a lot of sort of resi mortgage issuers are working on having STS transactions, and they have some in the pipeline. So it'll be interesting to see where they come. I just wanted to focus maybe on something else, which maybe because it tends to be overlooked in terms of what is very important on an MBS transaction is the consumer regulation side of things. Because compared with, for example, on a CMBS, where your underlying borrower will be a private equity company or a real estate investment fund, your underlying borrower is a consumer. It's people like you and me. And therefore, there's in every jurisdiction you deal with, you will have to comply with the underlying consumer regulation. So people tend to see the UK, for example, as being very sort of a robust and very a well-known jurisdiction. But working, for example, in Ireland on a resi mortgage, you have to make sure that. Sorry, I meant to say that in Ireland, for example, the enforcement of a resi mortgage is much more complicated than it is in the UK. So looking at sort of all sort of the underlying consumer regulation to ensure that your underlying asset will be able to be securitized from an enforcement point of view, as I've just mentioned, or from just simply a licensing point of view, the transfer of the assets, we need to have the relevant license in place, and you need to again to be able to transfer the assets to the issuer. So. Just wanted to make sure this wasn't overlooked because it's an important part of the transaction.
Thank you. I think we only have 3-4 minutes for questions and closing remarks. And in terms of closing remarks, if I could ask my panelists, what do you see as the main challenges for the next year, or the main opportunities, very briefly? I know that we can probably be here for the whole afternoon on that topic. Godfrey,
I would say
if I could,
originating new asset sufficient in the specialist space.
It's too easy to go down regulatory or Brexit, so the potential for a UK election and a government change. Kiwi withdrawal, I think, is going to see spreads widen as well, and potential increase in interest rates as well.
End of QE, first redemptions on the TLTRO in 2019, and the wild card is a new TLTRO. This would have the big impact on the covered bond market and the MBS market.
It's going to give a very boring answer, but I think as a lawyer, I'm excited to see how the new STS transaction come into place, because we've been talking about it for such a long time. It'll be interesting to see how it's done eventually.
Are there challenges left for me to cover here? I think I would throw on, just in terms of opportunity, I think we're excited about some of the new loan products, specifically the ones that Godfrey mentioned, that are interesting to us to look for.
Great. Thank you very much. Are there any questions from the audience? Well, thank you all for coming to our panel, and thank you, my panelists.
Thank you very much.
Thank you.
Okay.